Contrary to many people's expectations, interest rates are moving decisively lower. Central bankers themselves have said, look, we don't know how this next little while is going to play out. We're uncertain. And there's usually been, certainly over the last couple of years, an uncertainty sort of premium in interest rates as far as the market trying to figure out what it is central banks are going to be up to. But in this case here in March and now April of 2025, markets are saying, we hear central bankers, they're uncertain about interest rates. We're not as nearly as uncertain as they are about where the economy is going and what that means for growth and inflation expectations. And we can see this especially at the 2-year spot on the yield curve, not just in U.S. treasuries, but all over the world. Talk about German 2-year shots is making a big move. More recently, it's at its lowest rate since December. Even the Canadian 2-year is making a move, despite the fact that Canadian CPI, the last one, came in red, scorching hot. So you got the 2-year maturity on the yield curve, many yield curves. You got central bankers who are saying they're uncertain, and they're moving in the opposite direction. The market is saying rates are going lower because the economy is not looking good. And who better to bring in and talk about interest rates, and especially the 2-year spot on the yield curve, than Mr. George Gammon himself, another 2-year spot enthusiast. George, what do you make of interest rates moving, especially at this part of the curve, the 2-year? That's where we want to be, right?
The way I try to look at it, Jeff, is through starting with the economy and then asking, okay, what are these interest rates telling me about the economy? And then how do asset prices play into this? So I think for most of the viewers and watching your channel, I'm sure they've probably got this, but if they're new to the channel, I would encourage them to try to consider how asset prices affect the economy. So if we're just talking about aggregate demand, I always use the example of a hot air balloon. And in a healthy economy, you would have the balloon would be the creation of goods and services, productivity. And then the basket would be asset prices like housing and the S&P. So wherever that balloon went, the basket would also go. Unfortunately, in today's economy, it's the complete reverse, where the balloon, asset prices, and basket is economy. And so when we're trying to forecast what's going to happen to the overall economy, I think it's incredibly complex because you have to consider what the underlying fundamentals are, but then ask yourself what's likely to happen to the S&P 500, to the Mag 7, maybe even more specifically NVIDIA, and then what is going to happen to the housing market, because that unfortunately is going to play a major role in what will happen to the economy. So what I've been talking, or one of the things I've been talking about on my channel, is real estate. And we all know how important that is for aggregate demand. And Donald Trump has come out and said that he wants to make housing more affordable again, which I think is fantastic. We're in a massive housing bubble. Prices are way higher on pretty much every single metric than they were in 2006. And it's completely unaffordable for most people. But what's interesting about the way he's approaching making housing more affordable is he actually wants to bring prices down. Now, why is that interesting? Because what we've seen over the past 20 years are the central planners and the politicians, that's 25 years, trying to make housing more affordable just by adding subsidies. So they don't want the prices to go down. We don't want that. What we want is we want to somehow take financial engineering and make your monthly payment a little bit lower. Or we want to make your down payment a little bit lower, which obviously takes the risk and it puts it onto Wall Street's balance sheet, and effectively because of bailouts, that goes back to the taxpayer balance sheet. So what Trump is talking about, which I think is admirable, is actually bringing home prices down. So how is he proposing to do this? He's talking about eliminating a lot of regulations, red tape, and bureaucracy. Again, is absolutely what you have to do. If we want to make housing more affordable, we need to increase the supply of stuff. And so most people would say, okay, I think that's a good idea. But what you have to understand is the degree to which these regulations play into the cost of current homes.
Now, before we get back to the rest of today's video, I want to tell you about today's video sponsor. We talk all the time on this channel about the dangers the world is facing, trying to come to grips with the aftermath of the pandemic and the lockdowns, the difficulties associated with the supply shock and price illusion, not to mention still living in the shadow of the 2008 crisis. To put it mildly, there's a lot of systemic uncertainty. Now, I've recommended gold as a store value hedge for years. In fact, it's the ultimate error hedge. But if all you're doing is owning gold, you're only preserving your wealth, not growing it. And that's where today's video sponsor, Monetary Metals, comes in. With Monetary Metals, you can earn up to 4% in their leasing program immediately upon funding your account. And there are higher yields available to accredited investors in their bond offerings. The interest that you earn on your physical metal is paid in ounces of physical gold or silver, which you get in addition to any price appreciation from gold and silver while you hold them. So join the thousands of investors earning interest in physical gold and silver every month with Monetary Metals. There's a link in the description of this video that has all the information that you need. We thank Monetary Metals for their sponsorship, and now back to the rest of this video.
So I did some research on this, and right now, a new house, about 25% of the cost, I think it was 23.8 to be exact, is actually regulations. If you've got a $400,000 house, it was like $93,000 is regulation. And it gets even worse with multifamily, Jeff. With multifamily, it's about 40% of the cost of a new apartment building. You know, this, I'm sure Kenny McElroy, our good friend, knows this very well. So my point here is, let's think this through, because if he is able to reduce, let's just say half the regulation, and then he's also I'm assuming that he's going to be going after Fannie and Freddie, because I'm sure most of your viewers know that it's very rare to have a 30-year fixed rate mortgage. That is not a market type of loan, because the banks likely lose money on that. So it needs to be subsidized. And I'm sure they'll likely go after some of the FHA and some of these other programs that enable people to only put down 1%, 3%, 5% when a normal bank would make you put down, let's say, 20%. So all that juices housing prices. So let's just assume they're able to reduce the impact of FHA, Fannie and Freddie, these programs that are subsidizing the housing market, and they're able to get rid of half the regulation. Okay, I think it's realistic that a new home would cost, let's just say, 20% less. But what we have to understand is the home prices are set at the margin. So if you've got a house right now that's valued at quote unquote, or not quote unquote, but let's say it's valued at $400,000 because that's what the comps are in the area. If they set up a neighborhood right next to you where they're selling brand new homes for $100,000 less, then the comps are going to go down, and therefore the value of your house is also going to go down. So then we think, if, let's just say, nominal prices come down as a result of what Trump's doing, and again, I think it's on net, it's definitely beneficial. But what this does is this lowers nominal home prices substantially. And therefore, what does that do to purchasing power? And then you combine that with what we've had. I think the S&P 500 is down maybe, what, 10%?
Yeah,
like that.
Roughly 10%. Yeah.
So I think this may be another reason why bond prices, or excuse me, bond yields are coming down. Or in other words, growth and inflation expectations are coming down, because it's not just the economy, it's the impact of asset prices on the economy. And if you have those asset prices potentially going down with housing and going down with the S&P 500, that's just, I don't know, that would be the straw that would break the camel's back, but it's definitely a headwind to unsound underlying fundamentals.
Yeah, I think that you look at where the economic situation, even just to take what you just said, George, the fact that the Trump administration is trying to do a lot of different things. Even if you believe that those things are going to create benefits, as you're talking about in the housing market over time, he has himself said there's going to be a period of disruption. Nobody wants to use the word recession, but that's what they're winking and nodding at, right? There's going to be a period where you have to go through a transition. Even with tariffs, the idea with tariffs is, okay, we need to force manufacturing back in the United States. Whether you agree with it or not, if there's a long run benefit, in the short run, it's going to create all sorts of disruptions too. But I think what we're seeing in the interest rate markets is that central bankers call that uncertainty. When the bond markets are saying there's not a whole lot of uncertainty here, at least there's less uncertainty in bond prices going up and yields going down than it's portrayed to be. What the market is saying is, whatever you believe of policies or whatever you believe of the economic situation before those policies are introduced, things are moving in the wrong direction in a bunch of different ways. And that, what you just said about the asset price part of it, there's somewhat of a wealth effect as for stock prices on wealthier individuals. And it just so happens to be that wealthier individuals have been the main engine of consumer spending for the last year or so. So you get a correction in the S&P 500 that doesn't look like it's going to bounce right away like it has in the past. Last August, for example, This one looks like it's sticking. That's going to have a profound impact on wealthier individuals who've been the basis for consumption to begin with. So I think it's not just, I think that's what I keep coming back to. And I think what the market keeps coming back to, it's not one thing or another. We've encountered problems along the way, but it's coming from every single direction, no matter where you want to look at it. You can look at it overseas, you can look at it here domestically in the US. The idea was the US was the island of strength when everybody else was falling apart. Now it's okay, maybe the US isn't so strong either. So you can make a really good case from all of these different parts for why interest rates are going lower.
Yeah, and I think you also have to consider the psychological components, which very few people do. I'm talking about two different things here. But first and foremost, going back to what we were saying with the real estate market and what you're saying about uncertainty. I like to use real estate because that's something that everyone is pretty much familiar with. And you've got to put yourself in the position of a home builder right now. Let's just assume that 50% of your cost to build a house is lumber. What are you going to do? And you say, oh, I'll just build a house. Well, not so fast, because if that lumber is coming from Canada, you don't know what the price of that lumber is going to be tomorrow. And look, you can say that Trump is a great negotiator, and I would agree with you. But the bottom line is, if you're that home builder, you're thinking, okay, if I buy today, my lumber price is going to be X. If I buy in 2 weeks, my lumber price might be Y. And the big problem there is, if I build and then a month later, the lumber price goes back to X, then I got a big problem, because now I've got a house that I have to sell for $400,000, but my competitor is going to be able to sell that same house for, let's just say, $350,000. So what I'm saying there is, if the cost of lumber is 25% higher today, then you might not build that house, because you're concerned that if you build it at that price, 2 weeks later, the price of lumber is going to go back down to where it was, because there's no more tariff. And then your competitor is going to be able to build that house at a lower price. That's basically what I'm saying here. So what does that do? So if you're that home builder, it creates this environment where you're frozen. What that leads to across the entire economy is less economic activity. And that could contribute or lead to a recession. So that's the first component of psychology that I'd really encourage your audience to think through. The second one is narrative. And I talk about this all the time on my channel. And the more I study markets, the more videos I do, the more I realize how important this is. We know, it's obvious, the stock market has nothing to do with fundamentals. There's also an inverse relationship, right? So it's this whole bad news is good news and good news is bad news, because, it doesn't matter what they're doing. It doesn't matter how we're trading at a 38 PE, as long as the Fed's going to drop interest rates. Oh, bye-bye. That's what Jim Cramer tells us. But what we've had for the last 4 years is we've had a mainstream media that has just been a huge cheerleader for not just the administration, but also for the stock market. So they're one and the same, if you look at it through the lens of the mainstream media. But now all of a sudden, it's the complete opposite. So the mainstream media is going to be, they're obviously biased. Let's just call it a spade. Yeah. So they're going to have an incentive, let's say, to paint a gloomier picture than they otherwise would, not just about tariffs, but about any single policy coming from the Trump administration, and how that's going to be bad for the economy, bad for the stock market, bad for housing, bad for whatever. And you may believe it, you may not, but the bottom line is, there's a lot of average Joes and Janes out there where their opinion of the economy is going to come directly from the mainstream media. And if they believe that things are getting worse, then they're not going to spend as much. And then that is going to have a negative impact on the economy. That is going to create another one of these headwinds. So I'm always trying to determine which way the wind is blowing out there, as far as the media, to determine how that's going to impact consumer behavior. And I think right now, it's impacting it negatively. And I would just point to the University of Michigan survey. I would point to
the extreme Michigan survey.
Or was it the Conference Board? That's another one of these consumer surveys where you say, oh, George, they're politically skewed. I agree. First of all, they're getting less and less politically skewed from what I can tell. I think a couple months ago, at the University of Michigan, you saw that dramatic delta between Republicans and Democrats. But now it's like the Republicans are more coming around. And maybe it's not so great. Maybe the labor market, I'm not as optimistic as I was a couple months ago. But the bottom line is, Democrats spend money too. And if you figure they're 50% of 50% of society, and they are tightening their belt because they see all of this risk out there that may or may not be real. The bottom line is that is definitely going to impact demand. It's going to impact aggregate demand, and it's going to impact the U.S. economy. So
yeah,
then,
I think just to jump, I think it's a great point, because in a really strong economy, this might not necessarily matter, because you have an election. We see this every time there's a shift. You saw it in 2008 heading into 2009. The media was harsh on the economy in 2008. And then 2009, all of a sudden, green shoots everywhere. We saw it again in 2017. We saw it in 2020. There's always this back and forth with politics. But in a generally strong economy, you get the negative narrative and some people pull back in spending, but otherwise the economy's there and it can continue to flourish, despite the fact that half of the population is upset because their ticket or their party didn't win. I think that's, again, getting back to what we started with here, is that there's too many things going wrong, where you throw in the fact that Democrats are now really disappointed and really depressed. Even if they're not depressed about what you would consider a real thing, it's still going to make a big difference when, the straw that broke the camel's back, because the economic system right now can't afford any more weakness. It's just there's so many links in the chain that are becoming weaker and weaker.
Yeah, because when it's not about fundamentals, and that's psychology.
Yeah.
So then I guess the question becomes, why do interest rates go down when we have growth and inflation expectations going down? And this is something that I know you harp on constantly, and I try to address on my channel as much as I possibly can, because it's Jeff, it's if the Treasury, if Besant is coming out and he's going to issue 10 times more at the long end of the curve, I'm exaggerating obviously, but if he's going to issue more treasuries because, as our good friend Lynn Alden says, nothing stops this train. She's talking about government spending and government deficit spending. And therefore, that means more and more supply of treasuries. And regardless of Doge or Elon Musk or Trump, whatever their intentions are, the reality of the situation is, and I think we all agree on this, is that the U.S. debt is going to go one way, and that is up. It is not going to go down. So it's very intuitive to say, okay, if we have a lot more supply of treasuries and you have all these central banks that are dumping treasuries because now they want gold, they don't want that counterparty risk. And at a certain point, you just don't have any more balance sheet capacity. And therefore, if we have this deluge of supply, then the long end of the curve interest rates are going to go up. But then when we look at the 10-year treasury yield, we see that it's during all this deluge, it's gone from 4.8 all the way down to, I think maybe it's 4.15 today.
Yeah.
And to what we were talking about at the beginning of the video, the 2-year, I think, is trading at 3.86, 3.87, which
since early October,
which is way below Fed funds. So the 2 years telling you that the Fed funds rate is actually too high. So what's going on here? And I hear Jeff Snyder talk about inflation and growth expectations all the time, but why is that? Why does supply not matter? And I think that's very important for people to think through. I always tell the story of when I started doing videos, and I knew quite a bit, but I still had a very difficult time following like interviews that you would do on Macro Voices, as an example, or interviews with other guys and gals that were my favorites, like Lynn Alden or Brent Johnson or Luke Groman. And so what I would do is I would get very frustrated. As soon as I heard an interview with Eric and with Jeff Snyder, I would sit there and go to my whiteboard and I'd try to figure out and think through all the things that I didn't understand about that conversation. And one of the huge benefits of doing this is I started to realize how banks can settle using bank reserves, because this crazy guy named Jeff Snyder would always talk about the Eurodollar system and how it's cashless, reserveless. I understand how banks can create a loan and create cash or create a commercial bank deposit liability, but how on earth can they settle? And once you go through that process step by step, it probably took me 2 weeks, then you start to realize that there really isn't anything that's constraining bank balance sheets, Eurodollar system outside of the United States, with the exception of their risk management. That's really what it boils down to, because at the end of the day, they can create dollar credit to settle those transactions. They can create as many dollar currency units as they want to, because the offsetting asset to that liability is just the loan they created. So I don't want to get into the nitty gritty there to confuse your audience, but the bottom line is there is nothing that's constraining balance sheet capacity outside the United States except for risk management. That's pretty much it. and their own internal risk management controls. So what does this have to do with anything? If you think about it, if there is no balance sheet constraint, then they have a couple different options, these banks. Number one, they can use that balance sheet to lend into the real economy. So let's just assume right now they can lend at 6%. That's going to come with some substantial risk. Or what they can do is they can take that balance sheet and they can buy a 10-year treasury yielding 4.15%. Okay, that's going to come with a lot less risk. So the question is, what's the risk reward for each one? And therefore, which one makes more sense? So when you see the treasury yields come down, what that's telling you, especially at the long end of the curve, is that those banks, it tells you what those banks are doing with their balance sheet. And the simple fact that they are taking such a risk-off approach with that balance sheet capacity they have, which to a certain degree is almost, let's say, infinite, then this in itself tells you what they are predicting, not what they're saying, but what they're doing with their own money in regards to the global economy and to a certain extent, the United States economy. And one more thing, because a lot of people will say this is a stupid move because the inflation rate in the United States is at whatever, let's say it's going to go up to 5, 6, 7%. And if they've got a 10-year treasury yield that's yielding 4.15, then they're screwed. But what this fails to recognize is the fact that these banks, they don't care about the CPI. They don't care about inflation. It's completely irrelevant to them. Why? Because they're pocketing a spread. I did a video the other day, Jeff, on the dollar deposits. I picked like 15 random banks in the Cayman Islands. And
there are no banks in the Cayman Islands. They're just offices.
Or domiciled, right. Domiciled in the Cayman Islands. And pretty much all the banks, their dollar deposits, they were paying between about 1.5 and 2%. Okay, so let's think about that. You're paying 1.5% on your liabilities, those dollars, and you can take that and then you can buy treasuries yielding 4.15%. What's the problem? You're going to buy as many treasuries as you possibly can until you see growth and inflation expectations change. And then what's going to likely happen is you're going to have to pay more for those dollar liabilities. And then you're going to look out and you're going to see opportunities that you didn't see before. And then you're going to say, aha, now the risk reward to go ahead and collect that 6 or 7% by taking my balance sheet and using it to lend out to the real economy. Now that makes more sense than buying the treasury. And then what happens to the treasury? It goes down in price and yields go up. And the reason why I wanted to go over that is because so many people miss that component. And you talk about growth and inflation expectations all the time, but I think it's important for people to understand why that's true. And then if you need any reference points, I would strongly encourage your audience to go back to, let's just say 1980 and look at what the US debt was back then. I can tell you it's right around 800 billion. And then you fast forward to today and it's, let's just say 37 trillion with a T.
Huge.
Right. So we have had the supply, in other words, of treasuries go up by, let's just say $36 trillion. $36 trillion. That's over. I guess that's not, but that's a lot. That's a lot. And what has happened to interest rates since then? They've gone straight down. So how, if supply matters, how is that possible? How is it possible? And so then the counter argument, which is very good, is, okay, George, how come Argentina's bond market can blow out? How come the UK, we can have the gilt crisis, or we can have all these other things? And my view is because whether we like it or not, the dollar is the reserve currency and the dollar has the strongest network. That's what's important. The dollar really isn't a currency. It's just a network. And so it is by far the strongest network. It has the most powerful network that we have ever seen in human history. So what that means is the majority of those liabilities on banks' balance sheets are going to be dollar denominated. Okay, if they can't take that FX risk. So if their liabilities are dollar denominated, they're going to match up those assets to the best of their ability. That means dollar assets. That's really their only choice. It's almost like a TINA thing. There is no alternative. And whether you like it or not, it is what it is. And so when you're thinking about interest rates in the future, I think you need to really, not you, but the audience really needs to consider the mechanical components as to what drives interest rates and what motivates the biggest players in the market.
Yeah, Before we continue here, I do want to mention to people that this is the kind of stuff that we do at Rebel Capitalist, because you've got Rebel Capitalist coming up in a couple months here. It's the end
Yeah, the
of
conference,
May.
Rebel Capitalist Live.
Yeah, just so people who have never been to Rebel Capitalist before, this is the kind of stuff that we talk about there. And I'll be there this year as well as a whole bunch of other people. So,
you, Van Meter, Kiyosaki, by the way.
Yeah.
Going to be there. I don't know if I told you that. And Mike Maloney is going to be there.
Oh,
Johnson,
it's amazing.
so.
For me personally, I rarely get to many conferences. I rarely leave this place. But whenever Rebel Capitalist comes up on the calendar, that's the first place I'm going to go every single time. It's
Jeff
not
rarely leaves the Eurodollar bunker.
No, but Rebel Capitalist, that's circled on the calendar every single year. And so I really highly encourage, if you're at all interested in this, it really is these types of conversations. I go there and I talk to the audience there, and it's amazing to talk to people there, because they are highly motivated, highly interested, highly intelligent people who are doing exactly what George is doing, thinking through all of these things because they really want to make sense of the world. So I really enjoy going to Rebel Capitalist Live, and
we got a coupon. We got a coupon code for your audience.
There's
Jeff.
a coupon code on top, which is great. So there'll be, I think, a link in the description for that. So make sure that if you're interested in participating, coming and visit with everybody and having these discussions, make sure you get yourself to Rebel Capitalist.
Yeah, you
it's
can go
in
to
Orlando.
Rebel
What's the date on that?
May 23rd to the 25th. So they can just go to rebelcapitalistlive.com and then just use coupon code Jeff, and they'll get $100 off the ticket.
Yeah, like I can't recommend it enough. That's the one time I do enjoy getting out of the house. To be honest with you,
but getting back to those interest rates, what's the biggest issue? I'd be curious as to why people have a hard time understanding what really drives, especially at the long end of the curve. Is it just the fact that it's so counterintuitive?
That's the hardest part. Is number one is there's a famous quote from Milton Friedman: the hardest part of getting people to understand monetary economics is simply central banks. Because central banks craft a narrative in a way that's favorable to them, and they get interest rates backwards. They get treasuries backwards. They believe of interest rates exactly as you described them. The key component in interest rates is supply. So if there's increasing supply, then prices must adjust. And you hear this all the time from all these supposed experts too, including Treasury Secretary Bessent, who gets interest rates completely backwards, which is no surprise since he's a Wall Street guy. People like Zoltan Pozsar, who gets everything backwards as well. And they keep trying to push this idea that if supply goes up, then it's a ceteris paribus type of argument. And it's true. If supply went up and demand didn't change, then obviously prices would have to adjust in the way that they're saying. And so what you're talking about, George, is the mechanism for if supply is going up, demand is going up faster and farther, which is why prices adjust in the other direction. You have to look at the factors that go into demand for safety and liquidity. So that's why I always try to put it in those terms as you do as well, George. It's safety and liquidity, So you're not looking at it as an interest rate or a return necessarily, as a risk-adjusted return. And it has the lowest risk component. Therefore, the risk-adjusted return is oftentimes much higher. As you mentioned, the opportunity in an inflationary economy where you could get 7, 8, maybe even 10% in a real economy alone. If the risk is perceived to be huge, then you think, okay, it might be 10%, but the default probability is way higher on that than I am willing to take. So the risk-adjusted return might only look like, if you do some mathematical calculations, say it's only 2% or even 0, because you're really looking at 10% and thinking, I'm not sure I'm going to get my money back. So a 4% treasury or 5% treasury in that type of environment looks night and day, so much better than something in the real economy. So you have not just the banking sector, but you also have the non-banking sector making all the same calculations and running all the same numbers. And so you have banking sector balance sheets that are dedicated to more increasingly safe and liquid. You have non-bank balance sheets, massive amount of hedge fund balance sheet space that is dedicated to safety and liquidity, even if it's using tremendous leverage to generate returns. But you have all the entire financial system that creates demand for safe and liquid instruments over and above what the supply has been. And again, simple economics, price goes up and the interest rate goes down.
I'm glad you mentioned that, Jeff, because what I always say on my videos is, perversely, it's crazy to say this, but it's true. Supply actually creates its own demand. And when we're talking about treasuries. So why is that? It's I think you just hit the nail on the head there. And to explain to the audience, let's just say right now, inflation expectations are to 5 on a scale of 1 to 10. Let's just say they're to 5. And you, as a bank or one of these hedge funds or pension funds, something like that, you think that the fair price for a treasury, or where you're a buyer of a treasury, a 10-year, let's say, is at 4.15%, based on the fact that you think growth and inflation expectations, and doing the calculus or the calculation you just talked about, is at a 5. Okay. So now let's assume that Scott Bessent comes out and issues $3 trillion of 10-year treasuries, something like that, or $1 trillion, whatever it is. Okay. So temporarily, what is going to happen to that yield? It's going to go, let's just say, from 4.15, let's just say it goes up to 4.3. Okay, but you, as that bank, you're still looking at growth and inflation expectations at a 5 on a scale of 1 to 10. That didn't change. That didn't change at all. So if you're a buyer at 4.15, what are you going to be at 4.3?
A double buyer.
A double buyer. And then once you look at it through that lens and you combine that with the fact that they really don't, outside the United States, they really don't have much of a balance sheet constraint. And then you combine that with the fact that they're just pocketing a spread. So they don't care if the interest rate is under the CPI in the United States or the real inflation rate. Then I think, at least for me, it all starts to make sense.
Yeah, and especially when you consider how the non-banks use treasuries to obtain leverage, they're almost always in demand for safety and liquidity because there is no alternative to treasuries, and for the same reason. So it all comes back to the same thing. Again, that's the argument over supply makes sense only because you're never considering the demand side. And I think there's a lot of things that go into that as well, too, George, where people don't think there should be any reason why demand for treasuries is constantly growing faster than supply is. Because, again, the mainstream media, economists, central bankers do a horrible job about talking about real economic fundamentals. So there's always these misconceptions about why would there be so much demand for treasuries to begin with? It doesn't make a whole lot of sense. And you put it together. But like you said, it's just a little while ago, just since 2000, I think the U.S. debt was around $7 trillion in 2008 before we got into TARP and everything else. So we've got $30 trillion in additional debt over the last 17, 18 years. And the treasury rate, even despite rate hikes over the last couple of years, the interest rate is exactly the same. 30 trillion in additional debt, and the interest rate's the same. And the only reason the interest rate's the same is because the Fed is messing around in the front end of the yield curve, and interest rates are trying to defy the Fed and go lower. And as the Fed gets more and more out of the way, recognizing the fundamentals, rates keep pressing lower and lower, which brings us back to the initial part of our discussion here. That's the 2-year. What the 2-year is saying is what George said. The 2-year is saying the long end of the yield curve is seeing lower growth and inflation. We agree with that. The front end of the yield curve, where the Fed is, they're going to agree with the same things over time, not necessarily all at once. And so you have both parts of the yield curve that are likely to become more synchronized at some point in the future. And that's what the 2-year is saying. In the U.S. Treasury market, it's saying the same thing in the German market, despite the fiscal bazooka from Berlin. It's saying the same thing in Canada. The only place it's not saying the same thing is Japan, but we'll see how long that lasts. Even the Chinese government bond market got yields that are going down. So interest rates, fundamental, asset prices. I love your balloon analogy. You wonder what the balloon starts to look more and more like an anchor. And that's really, I think, what the bond market's really looking at.
Absolutely. The difficulty is the bond market isn't perfect. There's a lot of noise in there, which really confuses people and I think catches investors off sides. So what I'm referring to is now we've had the 10-year go from 4.8 all the way down to 4.15. So we're back where the majority of at least retail investors are recognizing the possibility of growth and inflation expectations slowing or yields coming down even further. But when we were at 4.8, what was the narrative? The narrative is
inflation.
Oh my gosh, we're in the 1970s. It's stagflation. The 10-year is going to go up to 6, 7. The Fed is going to completely lose control of interest rates. What are they going to do? They've painted themselves into a corner. And this was really what the talk was. And rightfully, then they also pointed out the fact that this cycle started off looking very similar to what we saw in 7. The same date, same Fed funds rate. They dropped by 50 to begin with. In the first year, they dropped by 100 basis points. It's the exact same thing in 2024 that we did in 2007. But then what they pointed out, and this was historically accurate, they said it is unprecedented, the move in the 10-year Treasury once the Fed started dropping rates. And I'm talking about the move with interest rates going higher. So when the Fed started dropping, that was September 18th, 2024. From that point, I think it might have even been on the day, the 10-year Treasury yield goes straight from like 3.8 right up to 4.8, goes up by like 100 basis points. So the people that are, let's say, the long end of the curve bears, they're saying, see, I told you, this is what we've got. Now there's no more demand. China isn't buying treasuries anymore, yada, yada. And then interest rates are just going to go straight to the moon. And my proof is right here that this is totally unprecedented, where the Fed is dropping rates at the front end of the curve and the long end of the curve is just skyrocketing. This fails to look at history. Yeah. So it is true that if you measure it from the point in which the Fed starts cutting, it was unprecedented. But if you look at it through the entirety of past cycles, it absolutely is not. So as an example, during the 2007, 2008, let's say Fed rate cutting cycle, from March of 2008 to July of 2008, when we were in recession, by the way, and we weren't in an inflationary recession, we were in a disinflationary recession. What did the 10-year Treasury yield do? It went up by 100 basis points. Exact same thing. And I'd also like to remind people, because we hear a lot of talk about stagflation, the CPI was right around 3.5% when the Fed started cutting in 2007, right around 3.5%. You fast forward to July of 2008, and the CPI was 5.6%. 5.6%. One thing that I love doing is going back and reading the Wall Street journals from the day or the day after those reports come out, to try to go back in a time machine and try to get a feeling for what it would have been like. What would I have been thinking? What would I have been feeling? What was the narrative back then? And looking at the Wall Street Journal, right after that 5.6 print came out, I believe it was in August, it was all stagflation. Yep. it was, oh my gosh, this is my gosh, it's the 1970s.
It was the same thing for the FOMC discussions. You read through the transcripts, and they're talking about in the middle of 2008, it really blows your mind. We need to hike interest rates here. We need to raise rates because we're worried about the economy roaring back and consumer prices getting out of control. We're talking about a month before Lehman Brothers fails and the entire system melts down. They're talking, we need to raise rates. And don't forget, the Europeans actually did it. They did it in July.
Did they? I didn't know that.
They raised rates in July 2008 because of inflation was going to get out of control. But yeah, George, I think you made a really good point that we probably should end on, is that markets are not perfect. And we talk a lot about the yield curve, talk about growth and inflation expectations as if we have a crystal ball. We certainly don't. And you look at the history of the market over the last just a couple of years, long-term interest rates have been relatively steady in a big picture term since October of 2022, but they sure as hell haven't been steady. They've been back and forth in wild swings over the last couple of years, largely because there's a tremendous amount of uncertainty related to these major macroeconomic conditions, which are becoming more and more certain, but also the uncertainty that's introduced by central bankers and officials who have no idea what they're talking about or doing. So if you're a market participant, like at the 2-year spot on the yield curve, you're looking at the long end for guidance on inflation and growth expectations. You're looking at the very front end. What is the Fed going to do? The Fed has no idea. It's going back and forth all the time. There's a tremendous amount of uncertainty. So you can go through any of these ups and downs and fluctuations in the yields over the last couple of years. And it's easy to make a case when rates are rising and say, okay, this is inflation. It's going to get out of control. It's easy when rates are going down to say, oh, this is a nightmare. It's 2008 all over again. So you really have to take a really balanced approach, understanding that markets are not perfect and that the yield curve is only one place to start. And you need to look at everything else that goes along with it. So I think it's a really good point too. Markets
right now, especially the labor market, that would have been the truth serum back then, as I think probably corporate credit spreads and the labor market, because we were seeing negative prints for the non-farm, I believe, every single time they were coming out back then. And you would have seen that unemployment rate. I don't have a chart in front of me, but in the middle of 2008, you would have gone
it was vertical up. By the middle of 2008, it was already going vertical. So that should have been a clue that it wasn't moving in the right direction.
Yeah. Another thing I want to point out, Jeff, is an inflationary recession is not a thing. And I see this on Twitter and on my social media all the time when people talk about stagflation is definitely a thing. But where people get it confused is they hear the term stagflation and what they think of is a recession where the inflation rate is actually accelerating. And they always point back to the 1970s. I would challenge your audience to actually look at the 1970s and look at the CPI during the 74, 75 recession. And then I believe it was, what was the other one?
69, 70 was the first one that really caught people off guard. And then 74, 75, and then the last one in the early 80s.
But look at when you get to that recession, And when you get to that point where the unemployment rate starts to really spike, look at what happens to the CPI. Look at what happens to inflation. It doesn't go down to zero. And that's not what I'm saying, but it goes down. We have disinflation, a recession where inflation is accelerating. Again, that's just not a thing. And a lot of people point to the fact M2 money supply has grown so substantially from, let's say, 2020 to 2024 or 2025 that you cannot compare the 1970s to what we have today. There again, I would strongly encourage people to go back and look at the rate of growth with M2 money supply from 1970 to 1974, and it was actually higher than it was, even with the huge spike of 25% that we had between 2020 and in 2021. It was still higher in the 1970s when we had those disinflationary recessions. So I want to make sure people understand that. And then one more thing, excuse me, is I know you always harp on the fact that bank reserves don't matter. And this is another thing that people really struggle with. And I'm not blaming it. I think it's very confusing. It's very esoteric. It's
hard to get
complex.
your head around it.
So why if the Fed takes their balance sheet to $9 trillion, how can that not matter? Or they're buying treasuries and increasing empty. How can this stuff not matter? Or how can that not increase the balance sheet capacity for these banks if they have an extra $8 trillion in bank reserves? And what I would, and I don't know if you've ever done this research, but I actually did it for a presentation that I gave, I think at the New Orleans Investment Conference. And I think you'll get a kick out of this. What I did is I went back to the 1940s and looked at how many bank reserves, or how much in bank reserves the Fed had on their balance sheet. So if we go back to 1940, let's say, the Fed had about $10 billion worth of bank reserves on their balance sheet. So this assets of the banking system, this is what you get the multiplier effect and all these things that they talk about in these textbooks. What's very interesting is, I believe it was in 1956 or 1959, they actually changed the law to where you could add the vault cash, where you could add vault cash to the amount of bank reserves you had in that metric. So to be clear, that number in 1940 was electronic bank reserves. That was not vault cash. Okay, so why does that matter? Because if we fast forward to 2007, we had about 40 billion of bank reserves. So that in and of itself, I think, is staggering and tells the whole story that from 1940 to 2007, but an increase of only $30 billion of bank reserves, yet somehow the amount of global dollar supply went from, I have no idea what it was in 1940, but I'm sure it wasn't a lot. And It goes to, let's say, 20, 30 trillion. Yeah, trillion. And the reason I want to harp on the electronic reserves is because those are the reserves that if banks were actually using to settle, they would be using the electronic reserves. They wouldn't be using vault cash, just sending a Brinks truck, or, that's not realistic, especially in today's day and age. So the punchline here is, if you just look at the electronic reserves, comparing apples to apples from 1940 to 2007, it's flat.
Same amount.
Exact same amount. It didn't change. 10 billion in 1940, 10 billion in 2007. So if you think bank reserves matter in the form of giving banks additional balance sheet capacity to settle transactions and do all these things, just explain that one to me. Explain that one to me. And the bottom line is, somehow we grew from a global dollar monetary system of, let's say, under $1 trillion to one in 2007 of over, let's say, $30 trillion without any additional bank reserves. The only way that is possible is if banks, especially outside the United States, are settling transactions, to your point, without bank reserves, without cash, because they are doing so by extending one another dollar credit. So if you have risk go up because the economy is slowing down, that's what we're seeing in the 10-year treasury yield, then those banks are going to be less willing to extend that credit to other banks, and you're going to have liquidity regardless of what the Fed is doing. And that's probably another thing that you're seeing playing out right now in interest rates.
Yeah, that's a really important point. That's why bank reserves tend to behave inversely to conditions in the monetary system, because the Federal Reserve sees the contraction in the economy, contraction in liquidity, and responds to it by creating bank reserves with the hope, maybe even a little bit of an expectation, that the level of bank reserves will influence bank behavior, but it never works. I think it's the single biggest aha that you can get to, what you just went through. The world worked really well and fine with no bank reserves. Then in 2007, we get all these bank reserves and suddenly the world doesn't work. And once you realize the truth behind that, it's not the bank reserves that matter. The bank reserves are simply a response to the world not working. Things make a whole lot of sense. Yep. That's why we love having you on, George, because when you come on, the way you always explain things and really pull things apart, suddenly all of these complex topics do start to make a lot of sense. So I really appreciate your time and joining me here, going through interest rates. Remember, everybody, check out Rebel Capitalist Live. Like I said, that's one of the best times that you can have.
And use coupon code Jeff.
Coupon code Jeff.
You get $100 off.
Yes, exactly. I hope to see you all there. And again, thanks, George, for joining me. Really appreciate it.
Thanks for having me on.